In 2019, a journalist named Aaron Glantz published a book that should have started riots. It was called Homewreckers. Glantz spent years tracing what happened to millions of American homes after the 2008 financial crisis. Families lost everything, banks collapsed. The housing market cratered, and then something strange happened. While ordinary Americans were still reeling, still recovering, still trying to repair their credit scores, a new type of buyer entered the market. They weren't families, they weren't investors looking for a few rental properties. They were Wall Street firms with billions of dollars in capital, buying foreclosed homes by the thousands, sometimes by the tens of thousands. In some neighborhoods, in some cities, they bought entire blocks. They paid cash, they closed in days, they outbid everyone. Glantz documented how these firms scooped up the wreckage of the American dream at pennies on the dollar. And then, with perfect irony, they rented those same homes back to the families who couldn't afford to buy anymore. The crisis that destroyed homeownership for a generation became the foundation for a new business model, one where you don't buy a house, you subscribe to one. That book was published 5 years ago. Since then, the trend has accelerated. The firms have gotten bigger, the strategy has spread. And the question nobody in power seems willing to answer is this: what happens to a country when corporations own the neighborhood? Before we go further, let's clear up a confusion that dominates this conversation. When people talk about Wall Street buying homes, they usually say BlackRock. BlackRock is the world's largest asset manager. Over $10 trillion under management. It's become a symbol for everything people fear about corporate consolidation. But here's the thing. BlackRock, the company, doesn't actually buy single-family homes directly. That's not their business model. They manage funds. They invest in stocks and bonds. They're enormous, but they're not the ones showing up at foreclosure auctions. The company people are usually thinking of is Blackstone. Different firm, different model. Easy to confuse, which is probably not an accident. Blackstone created a company called Invitation Homes, which became the largest single-family rental company in America. At its peak, Invitation Homes owned over 80,000 houses. But even Blackstone isn't alone. American Homes 4 Rent Progress Residential. Tricon Residential Premium Partners, a constellation of institutional landlords, now controls hundreds of thousands of single-family homes across the country. And BlackRock, while not buying homes directly, does invest in many of these companies through its funds. So when your retirement account holds a BlackRock ETF that holds shares in Invitation Homes, you are, in a weird way, profiting from the housing crisis. The lines blur on purpose. That's how modern finance works. But the core phenomenon is real. Wall Street discovered that houses aren't just homes, they're assets. Predictable, stable, inflation-protected assets that generate monthly cash flow from people who have no choice but to pay. And once they realized that, everything changed. To understand how we got here, you have to go back to 2012. The housing market had crashed. Home prices were down 30% from their peak. Millions of properties sat vacant, foreclosed, owned by banks who didn't want them. Traditional buyers couldn't get mortgages. Lending standards had tightened dramatically after the subprime disaster. Even people with decent incomes and good credit found themselves locked out. That left a vacuum, and into that vacuum stepped private equity. Blackstone launched Invitation Homes in 2012 with a simple thesis: buy distressed houses cheap, renovate them minimally. Rent them to families who can't afford to buy. The math was beautiful. If you buy a house for $100,000 that was worth $200,000 before the crash, and you rent it for $1,500 a month, you're getting an 18% annual return on invested capital. Before appreciation, before rent increases. 18%. In an environment where treasury bonds paid almost nothing. Institutional money flooded in. Blackstone raised billions. Competitors followed. By 2013, institutional investors were buying roughly a quarter of all foreclosed homes in some markets. Phoenix to Atlanta, Charlotte to Tampa, Las Vegas. The cities hit hardest by the crash became hunting grounds. And here's the detail that matters. These weren't luxury homes. These weren't Manhattan penthouses. These were starter homes, the 3-bedroom ranch in the suburbs, the first house a young family might have bought. The entry point to the American wealth ladder was being systematically purchased by people who already had more wealth than most Americans would see in a lifetime. Let's talk about how the buying actually works, because this is where the math turns uncomfortable. When a regular buyer tries to purchase a home, they go through a gauntlet. Pre-approval inspections, appraisals, contingencies, financing delays. The process takes 30 to 60 days minimum. Institutional buyers don't do any of that. They pay cash, they waive inspections. They close in a week, sometimes faster. If you're a seller, especially a distressed seller, especially a bank trying to offload foreclosed inventory, who do you choose? The family that might take 2 months and whose financing might fall through? Or the corporation that wires money in 5 days? It's not even a competition, but it gets worse. These firms don't just buy homes passively. They've built proprietary technology to identify and acquire properties at scale. Algorithms scan listings within minutes of posting. Automated valuation models calculate maximum bids based on projected rental income. Teams of buyers in every target market are ready to move immediately. One company bragged about buying a home every 20 minutes at their peak. A family looking at houses on Zillow during their lunch break is competing against a machine that never sleeps, backed by billions in capital, optimized for speed. This is not a fair fight. It was never meant to be. Now, here's where defenders of this model push back. They say institutional investors only own a small percentage of total housing stock. And technically, that's true. Depending on how you count, institutional landlords own somewhere between 2 and 3% of single-family homes nationally. 3% doesn't sound scary, but that number is deeply misleading. First, the buying is concentrated. Institutional investors aren't buying homes in rural Nebraska or the suburbs of Pittsburgh. They're targeting specific markets. Sunbelt cities, growing metros, places where rents are rising and population is increasing. In some zip codes in Atlanta, institutional ownership exceeds 30%. In parts of Phoenix, it's higher. In specific neighborhoods, specific streets, one landlord might own every fourth house. Second, the marginal buyer matters more than the total stock. Home prices aren't set by who owns the most houses. They're set by competition for the houses currently for sale. If institutional buyers are absorbing 20 or 30% of available inventory in a given market, they're not a minor player. They're a price-setting force. Every house they buy is a house a family didn't get. Third, the trend is accelerating. Institutional buyers represented roughly 1% of purchases in 2010. By 2021, in some markets, they represented over a quarter. The percentage of total ownership is low because they're new. Give it 20 years. The math says this ends with corporations owning a significant chunk of the suburban American housing stock, not because of conspiracy, but because of compound returns and patient capital. Let's talk about what it's like to rent from Wall Street. The pitch sounds reasonable. Professional management. Consistent maintenance, and apt to pay rent and submit requests. Modern amenities, no amateur landlords forgetting to fix the furnace. The reality is more complicated. Investigations by journalists at Reuters, ProPublica, and others have found consistent patterns across institutional landlords. Aggressive fee structures, late fees, convenience fees, pet fees, smart home technology fees. Some tenants report paying hundreds of dollars in additional monthly charges beyond base rent, automated enforcement. Miss a payment by a day and the system flags it. Lease violations generate notices instantly. The relationship is transactional in a way that a local landlord might not be. Rapid rent increases. Institutional landlords raise rents more aggressively than small landlords, according to multiple studies. They have the data. They know what the market will bear. They have shareholders expecting growth. And here's the structural issue. When your landlord is a publicly traded company or a private equity fund, their obligation isn't to you. It's to their investors. Every dollar they don't extract from tenants is a dollar their shareholders don't receive. The incentives are perfectly misaligned. A local landlord might keep your rent flat because they like you, because it's not worth the hassle of finding new tenants, because they're human, and humans sometimes make suboptimal financial decisions. An algorithm doesn't like you. An algorithm optimizes. Let's zoom out to the hidden mechanism that makes all of this possible. Why can Wall Street afford to pay so much for houses? Why can they outbid families who would live in those homes and treat them as more than financial instruments? Because they have access to something you don't, cheap capital. When interest rates were near zero, as they were for most of the past decade, institutional investors could borrow at rates unavailable to regular buyers. They could leverage their portfolios. They could issue bonds backed by rental income streams. A family buying a house gets whatever mortgage rate the bank offers them, 6%, 7%, whatever the market dictates. Blackstone raises capital from pension funds and sovereign wealth funds at a fraction of that cost. They issue corporate bonds at low rates. They securitize rental income just like Wall Street securitized mortgages in 2006. Different access, different math, different outcome. And when the Federal Reserve kept rates low for years, ostensibly to help Americans recover from the crisis, they were simultaneously making it cheaper for institutional buyers to vacuum up housing inventory. The policy meant to help create conditions for displacement. This isn't a conspiracy, it's just incentives. But the result is the same. A system that privileged capital over families. Every month you pay rent, you're generating returns for someone else's retirement fund, maybe even your own if your 401k holds the right index funds. The irony is perfect. You can't afford a house because Wall Street bought it. And Wall Street bought it partly with money you invested. Here's the part that keeps housing researchers up at night. For most of American history, the primary way middle-class families built wealth was through homeownership. Not stocks. Most Americans don't own significant stock portfolios. Not small business. Most people don't start companies' houses. You buy a house in your 30s. You pay it off over 30 years. You retire with an asset worth 5 or 10 times what you paid. You pass it to your children or sell it to fund your retirement. That was the model. That was the American dream in financial terms. But the model assumed people could buy houses. If an entire generation is locked into permanent renting, what happens to wealth accumulation? What happens to retirement security? What happens to the gap between those who own and those who don't? The data is already showing it. Millennials have the lowest homeownership rate of any generation at the same age. Gen Z is tracking even worse. This isn't because young people don't want homes. Surveys consistently show they do. It's because they can't afford them. And every year they rent instead of buy, they fall further behind. Rent is an expense. It's money out the door. At the end of 30 years of renting, you have nothing. No equity, no asset, just receipts. At the end of 30 years of ownership, you have a house. Even if it didn't appreciate at all, you have something. The difference between those two paths, compounded over a lifetime, is hundreds of thousands of dollars, maybe millions. And that difference increasingly depends not on how hard you work or how much you save. It depends on when you were born and whether you got into the market before institutional capital locked you out. Let's contrast the hype with reality for a moment. The optimistic case says this: institutional landlords provide needed rental housing. They professionalize a fragmented market. They invest in properties that might otherwise decay. They give people options. And look, there's some truth there. Plenty of small landlords are terrible. They ignore maintenance, they harass tenants, they discriminate. A corporate landlord, whatever its flaws, at least has processes, accountability, documentation. And in markets where housing supply is genuinely constrained, having any landlord provide housing is better than having homes sit vacant. But here's what the optimistic case ignores. Housing isn't just a market. It's infrastructure for everything else. Stable housing enables educational achievement. Kids who move constantly perform worse in school. Families who own have roots, connections, and stakes in their communities. Homeownership creates civic engagement. Owners vote more. They attend school board meetings. They care about local politics because they have skin in the game. Wealth accumulation through housing funds, retirements, college educations, and small business starts. It's the primary mechanism of intergenerational wealth transfer. When you financialize housing, when you turn homes into yield-producing assets for distant investors, you hollow out everything that housing was supposed to support. You get a country of renters, atomized mobile, precarious, paying 30 or 40% of their income to entities they'll never meet for the privilege of not being homeless. Is that the future anyone voted for? The question nobody can answer is where this ends. In theory, market forces should create limits. If institutional buyers push prices too high, rents have to rise to cover costs. If rents rise too high, tenants leave. If tenants leave, landlords lose money. The market corrects. But what if it doesn't? What if housing is so essential, so non-optional, that tenants simply absorb whatever costs landlords impose? What if people don't leave because there's nowhere else to go? What if institutional ownership becomes self-reinforcing? The more homes they buy, the fewer homes regular families can buy. The fewer homes families buy, the more they have to rent. The more they rent, the more profitable rental housing becomes. The more profitable it becomes, the more capital flows in. A doom loop, financialization feeding on itself. Some cities are pushing back. Restrictions on institutional buying, caps on rental increases, right of first refusal for tenants when properties sell. But capital is patient and mobile. If Phoenix restricts buying, money moves to Raleigh. If California passes rent control, institutional buyers target Texas. The money will find a home. That's what money does. There's an old saying in economics, if something can't go on forever, it will stop. But the question is how it stops. Maybe interest rates stay high enough that institutional returns compress and the buying slows. Maybe new housing construction finally catches up with demand and prices stabilize. Maybe political pressure forces structural reforms, or maybe none of that happens. Maybe we drift into a future where homeownership becomes what it was before the 20th century, a privilege for the wealthy, a status marker. Not a reasonable expectation for working families. That world already exists in many countries. Germany has lower home ownership than the US, Switzerland even lower. People rent for life. It's normal. But those countries have something America doesn't. Strong tenant protections, lifetime leases, rent controls that actually function, social housing that provides alternatives. America has none of that. America has the worst of both worlds, a culture that still promises home ownership as the American dream, and an economy that increasingly makes it impossible. Aaron Glantz called his book Homewreckers because he saw what the vultures did after the crash. But maybe the real wrecking is still ahead. Not the dramatic crisis, not the sudden collapse. Just a slow transformation, year by year, house by house. Until one day, you look around and realize the neighborhood isn't yours anymore. It belongs to a company whose name you can't pronounce, managed by an algorithm that doesn't know you exist, optimized for returns you'll never see. And the only question left is what you're going to do about it.